Our next item deals with the dual nature of transactions, which is a fancy way of saying we are going to record transactions on the buyer's books and then on the seller's books. If you were to look at the next page, I've given you all these journal entries there. That really is everything we've covered so far in this chapter. Those are all the journal entries right there. So I think that's a really great study tool right there. All of the journal entries right there at one place for you. You may want to be looking at them right now as we start making these journal entries. What we're going to do now, if you look at the next page, we have a number of transactions. And do you see we have a column for the buyer, and then we have a column for the seller. We're going to take transactions, we're going to record them on the buyer's books, and then on the seller's books. This is just the way I'm going to give it to you on the test, because I think it's a lot easier if we record the same transaction on both parties' books, because there's some relationships that we can see between the two. Now we're going to make the assumption that any time I buy merchandise, I'm going to resell it. That's the assumption inherent in what we're doing right now. First example, Darth Vader buys from Yoda on account. 10 lightsabers, $400 each, 210 net 30, FOB shipping point. Lightsabers originally cost Yoda $250 each. But you need to write small and you need to write clearly here. Now, we're going to be the buyer first. First off, let's figure what is the amount. Well, I bought 10 lightsabers at $400 each. It's a total then of $4,000. So I'm going to show you the amounts in this column also. Now, really, there's a couple of things in that example that I don't need to know right now when I record this initial transaction. What's one? 210 net 30, good. When am I going to need 210 net 30? When the payment is made, good. Is there anything else here that I don't need? FOB shipping point. When will I need FOB shipping point? When the freight costs are paid. I am the buyer. I have now bought 10 lightsabers. My plan is to resell those items in. What do I have more of? Merchandise inventory. Inventory is an asset, and assets go up with a debit. So let's debit inventory. What else do I have more of? I have more accounts payable. I owe more money. Accounts payable is a liability. Liabilities go up with a credit. So I need to debit merchandise inventory to make the asset go up. I need to credit accounts payable to make that liability go up. Now we'll take off our Darth Vader mask, and we're going to put in our Yoda mask now. We're the ones who have now made this sale. What do I have more of? Accounts receivable. I have more accounts receivable. My customer owes me more. Accounts receivable is an asset, and assets go up with a debit. What else do I have more of? Sales. Sales is what a merchandiser calls its revenue. I have more revenue. Revenue goes up with a credit. Debit accounts receivable and credit sales. The seller must also make a second entry to update their inventory. Because if I've sold some items, well, part of my inventory is gone. I need to make it go down. This second entry will be made for how much that inventory cost me. Well, I sold 10 items. Each one originally cost me $250. So in total then they cost me $2,500. What do I have less of? Less inventory. So if you would skip a line right now for the debit, we'll come back to that. I have less inventory. Inventory is an asset. Assets go down with a credit. So we're going to credit merchandise inventory. When I buy that inventory, it was an asset to me. When I sell it, it becomes what to me? An expense. And we call that expense cost of merchandise sold or cost of goods sold. Most important to remember, cost of goods sold is an expense. So the seller makes two journal entries when they make a sale. The first one to record the revenue, the second one to update the inventory. How did I do in this transaction? I did pretty good, I think. I bought merchandise for $2,500. I turned around and sold it for $4,000. In other words, I made a profit of $1,500. That $1,500 doesn't show up in my journal entry anywhere. Instead, when I go to prepare the income statement, I will show sales revenue of $4,000, cost of goods sold of $2,500. I have a profit then of $1,500. Notice, if the buyer has more inventory, the seller must have less inventory. Now, they have two different amounts for the inventory because each one shows inventory at what it costs them. If the buyer has more accounts payable, the seller must have more accounts receivable. Darth Vader didn't like two of those lightsabers, returned it to Yoda. He has not paid for them yet. Instead, Yoda will reduce the amount that he owes him. We're back to being Darth Vader now. We have just returned the lightsabers. What do I have left off? My accounts payable has gone down by $800. Accounts payable is liability. Liabilities go down with a debit. What else do I have left off? I have less inventory. I sent part of it back. Inventory is an asset. Assets go down with a credit. Well, let's be Yoda, who is receiving those return items from the customer. When a customer brings something back to us, we have a separate account we record that in called what? Sales, returns, and allowances. Very good. It is a contra account to sales. Sales has a credit balance. Sales, returns, and allowances has a debit balance then. So when a customer brings it back to us, we debit sales, returns, and allowances for the amount of the refund. What do I have left off? Accounts receivable. He doesn't owe me as much anymore. Accounts receivable is an asset. Assets go down with a credit. So we would debit sales, returns, and allowances, and we would credit accounts receivable. We also have to make a second entry to update our inventory, because the assumption here is the customer brings the items back to me. There's nothing wrong with them. I'm going to put them back on the shelf and sell them to the next customer. There's nothing wrong with them. What do I have more of? Merchandise inventory. Now I have $500 more inventory, okay? Those items came off my books originally at $250 each. When I put them back on, I have to put them back on at $250 each also. I have more inventory. An asset goes up with a debit. The credit is what's a little bit odd here. The credit goes to cost of goods sold. I say that's odd because what type of an account is cost of goods sold? It's an expense. When we credit an expense, we make it go down. Well, I recorded these items as an expense when I sold them. Now I actually didn't sell them, did I? So I need to cancel out that cost of goods sold that I recorded in the original sales entry. Let's pause for a minute right there. Let's look at the buyer's books. And I want you to tell me how the entry for the buyer's return compares to the entry for the buyer's purchase. They're reversed. They're the exact opposite, aren't they? I want you to look at the seller's books now. Tell me how the entry for the return on the seller's books compares to the entry for the original sale. Almost the exact opposite. Almost the exact opposite. There's one little piece that is not the exact opposite. What is that? Sales RNA. Sales RNA. We credited sales in the original entry. For the return, we don't debit sales. We debit sales, returns, and allowances, that contra account instead. Other than that, it's the exact opposite. So I mentioned that because I think it means we don't have to memorize quite so much if we can look at the previous entry and kind of figure it out from there. Notice if the buyer has less accounts payable, the seller has less accounts receivable. If the buyer has less inventory, the seller must have more inventory. The appropriate party pays the freight bill, FOB shipping point. Legal title to the goods passes at the point of origin. When we put them on the plane, the train, the boat, the spaceship, whatever, to send them to the customer, the whole time the goods are in transit, who do they belong to, the buyer or the seller? The buyer. The buyer records the freight cost with a debit to what? Merchandise inventory. That's one of those I've already warned you students don't like. We're going to credit cash because he paid it. If we had only received the bill but not yet paid it, we credit accounts payable. Debiting inventory makes that account go up. Do we have more inventory? No. But did the inventory cost me more? Yes. And that is why I'm debiting merchandise inventory, to make that account go up to reflect the full cost of acquiring the inventory. The seller does nothing. Only one of the two parties records the freight, and in this case it was the buyer, not the seller. Darth Vader pays Yoda on day 10. Well, the first thing we need to see is how much does he owe. How much was his original purchase? $4,000. But then what happened in the second entry? Sent back $800. So at that point, we now owe $3,200. Can we take a discount? What percent? 2. 2% discount. Now the 2% comes off of the $3,200, not the $4,000, the $3,200. So we can save $64. How much do I owe? Well, $3,200 minus the $64 says I will only pay $3,136. Let's make a journal entry now. We're on the buyer's books. What do I have less of? I have less accounts payable. Good. Now, how much is accounts payable balance on my books right now? $3,200. So I need to make accounts payable go down by its current balance, $3,200. All right, accounts payable needs to go down by $3,200 to get it off of my books. What else do I have less of? Cash. How much less cash do I have? $31.36 is what I actually had to pay. That doesn't balance. To make it balance, I need another credit for $64, and it goes where? I heard sales discounts, and I always hear sales discounts, but who can use the account of sales discount? Seller is the only person who can use the account called sales discount. What account do we credit for the discount instead? Merchandise inventory. Again, highlighted. I tell you there are a couple things I know students are likely to miss, and that's one of them. Credit merchandise inventory for the discount that we take. Crediting inventory does what? Makes it go down. Do I have less inventory now? Well, no. But did my inventory cost me less? It did, because I paid in a timely manner and saved $64. So we credit merchandise inventory to make that asset account go down because we saved money. Okay, we want the asset account to reflect what we really ended up paying. Let's do the same transaction on the seller's books. What do I have more of? Cash. $31.36 is how much cash I have. What do I have less of once this customer pays me? Accounts receivable. Please skip a line. Skip a line because we need another debit. How much do we need to credit accounts receivable for? $3,200. The full amount that's on my books for right now, I need to get it off of my book. I need another debit, $64. Where does that debit go? Perfect. Sales discounts. Only the seller can use the account of sales discount. A contra account to sales, when we debit that account, we make it go up. Customers have taken more sales discounts. Why could I not simply debit cash for $31.36, credit accounts receivable for $31.36? It would leave a $64 balance in accounts receivable. Look like my customers owe me $64. They actually don't owe me anything. Notice that if the buyer has less accounts payable, the seller must have less accounts receivable. If the buyer has less cash, the seller must have more cash. Now, on the side somewhere, I would like for you to draw a T account because I want you to look at merchandise inventory and see what's happened in that account. Now, we're going to be looking at the buyer's books right now. The first transaction did what to merchandise inventory on the buyer's books? Debited it for $4,000. The second transaction did what to merchandise inventory on the buyer's books? Credited it for $800 to make it go down. So right now, my balance in merchandise inventory is how much? $3,200. Now we're going to ignore the freight entry for right now. Going to ignore that because we paid that to someone different. How about that last entry we just made? What did it do to the merchandise inventory account on the buyer's books? Credited it for how much? $64. That last journal entry credited merchandise inventory for $64. What balance does that leave me right now in merchandise inventory? $31.36. Have we seen that number $31.36 before? That's what we ended up paying for the merchandise. So we have to credit merchandise inventory for the amount of that discount we take to bring that account down to what the inventory actually cost me. Another transaction. Darth Vader sells to Luke 6 lightsabers, $500 cash. Now remember Darth Vader bought lightsabers just a minute ago? How much did Darth Vader pay for those lightsabers when he bought them? $400 each. Now hold that number in mind, then we're going to come back and talk about it. Do me a favor and make the journal entry on the buyer's books. You have bought inventory and you paid cash for it, please. What do I have more of? I have more inventory. Inventory is an asset, and assets go up with the debit, so I'll debit merchandise inventory. What do I have less of? Cash. Less cash, and asset goes down with the credit. Now I want you to make the first entry on the seller's books. What account do we debit? We have more cash, and asset goes up with the debit. What account do we credit? I have more sales. That's revenue. Revenue goes up with the credit. Now my next entry is to update the inventory, because when I make a sale, part of my inventory is gone. I asked you a minute ago how much did the lightsabers cost Darth Vader when he originally bought them, and you said $400, which is the right answer, almost. Let me back up now and say we're going to use $400 for our journal entry, but I just want to show you one item. Actually, $400 isn't exactly what they cost him. Now to begin with, he bought $4,000, sent back $800, net cost of $3,200. Now if we stop right there and divide by the 8 lightsabers that he kept, that would give us the $400 each, right? But two more things happened that affected the cost of my inventory. First off, I paid in a timely manner so I could take a discount. That reduced the cost of my inventory. Secondly, I had to pay the freight cost to get the items delivered to me. That increased the cost of my inventory. So actually, he paid $33.36 for those 8 lightsabers. Divided by 8 says he really paid $417 each. Now, for our purposes, we're going to keep life simple. We're going to use the 400. We're going to use the 400. But I just want you to see that in actuality, it gets more complicated. Now, we're going to go back to assume they cost me $400 each. So we sold 6 of them, so they cost me $2,400 in total. Now let's make the entry to update the inventory. What do I have less of when I make this sale? Inventory is an asset, and assets go down with a credit, so you might want to skip the debit, but for right now, my credit goes to merchandise inventory to make the asset go down. And when I sell inventory, it becomes what to me? Cost of merchandise sold, an expense. So I have more of an expense of cost of goods sold. I have less merchandise inventory, that's an asset, and assets go down with a credit. How does this sale look in Darth Vader's book as the seller compared to the previous credit sale that we made? In other words, the very first entry we recorded was a credit sale. How does this cash sale compare to the credit sale that we previously recorded? Forgetting the numbers, just looking at the account. Looking at the account. It's almost the same, isn't it? The only difference between the cash sale and the credit sale is debiting cash versus accounts receivable. So I tell you that, so if you earn one set of journal entries, the other one is really similar. If the buyer has less cash, the seller has more cash. If the buyer has more inventory, the seller has less. Luke brings back 2 lightsabers. Brings back 2 of them. Didn't like them. Brings them back. All right. Has he paid for them yet? Will we give him his money back? Yes. All right. Let's be Luke right now. We are the one returning those lightsabers for a refund. What do I have more of? Cash. Going to get $1,000 cash. Cash is an asset, goes up with a debit. What do I have less of? Merchandise inventory is an asset, and it goes down with a credit. Let's be the seller. Customer is bringing these goods back to me. When a customer brings something back to me, I debit what account? Sales R&A. Sales returns and allowances, which is a contra account to sales. Debiting it makes it go up. What do I have less of? Less cash. Cash is an asset, and it goes down with a credit. My second entry says I need to update the inventory to put these items back on the books because I'm going to turn around and sell them to the next customer. What do I have more of? More merchandise inventory. Now this entry is going to be for what these items cost me. They originally cost me $400 each. Actually $417, but we're going to go with $400. Those items came off my books at $400 each. I had to put them back on my books at $400 each. More inventory is an asset, goes up with a debit. The credit is what I think is a little bit odd. The credit goes to cost of goods sold. Cost of goods sold is an expense. When I credit an expense, I make it go down. Pretty odd to credit an expense, except we recorded these items as an expense when I sold them originally. Now it turns out we really didn't sell them. We need to cancel out that journal entry, the debit to cost of goods sold that we made in that original entry. Buyer has more cash, seller must have less cash. Buyer has less inventory, seller must have more inventory. New transaction. Darth Vader buys from Wano 20 lightsabers, $450 each, 310 net 60. Lightsabers originally cost Wano $275, and it's FOB destination. What of that do I not need right away? 310 net 60, except I didn't tell you if this is a cash or credit sale. When you see those terms there, you automatically know what? It's a credit sale. It's a sale on account. Anything else I don't need right away? FOB destination. All right, I want you to take a minute and record both sets of journal entries. On the buyer's books, making a credit purchase. On the seller's books, making a credit sale. What does the buyer have more of? Merchandise inventory, an asset, goes up with a debit. What else does the buyer have more of? Accounts payable, liability, goes up with a credit. The seller has more what? Accounts receivable, an asset, goes up with a debit. The seller also has more sales, revenue, goes up with a credit. All of those entries are for $9,000. The second entry will be for how much those items cost him. $5,500 in total. What do we have less of? Less merchandise inventory and asset goes down with a credit. But when I sell the inventory, it becomes what to me? An expense, and my expense of cost of goods sold goes up with a debit. So debit accounts receivable to make the asset go up, credit sales to make revenue go up, debit cost of goods sold to make the expense go up, credit merchandise inventory to make the asset go down. The buyer has more inventory, the seller's got to have less. The buyer has more accounts payable, the seller has more accounts receivable. Freight bill, FOB destination, legal title to the goods passes when they arrive at the destination. The whole time the goods are in transit, who do they belong to, the buyer or the seller? The seller pays the freight cost with a debit to what? Delivery expense. Good. Debit to delivery expense, which is just an ordinary expense for the income statement. Buyer does nothing, and I credited cash because I said he paid it. Had he received the bill but not yet paid it, it would go to accounts payable. Darth Vader pays on day 58. Can he take the discount? No. Jot down the journal entry. This takes us back to chapter 2 at this point, really. Okay? Back to chapter 2, just paying off the liability. What does the buyer have less of? Accounts payable, liability goes down with the debit. What else does the buyer have less of? Cash and asset down with the credit. What does the seller have more of? Cash and asset up with the debit. And what does the seller have less of? Accounts receivable and asset goes down with the credit. Buyer has less accounts payable, seller's got to have less accounts receivable. The buyer has less cash, the seller's got to have more cash. Darth Vader returns 2 lightsabers. He bought them on account, but now he's paid for them. Will we give him his money back? Yes. Let's be the buyer first, returning the merchandise and receiving cash for it. What do I have more of? Cash and asset goes up with the debit. What do I have less of? Merchandise inventory and asset goes down with a credit. How about the seller? What account do we debit when a customer brings something back to us? Sales returns and allowances. We have more sales returns and allowances. A contra account to sales goes up with a debit. Good. What do I have less of? Got to give them some money back. Less cash and asset goes down with the credit. My next entry is to update the inventory. I've got to take these items, put them back on my books. They came off of my books at $275 each. They've got to go back on my books at $275 each. What do I have more of? More inventory. Inventory is an asset, goes up with the debit. And the credit goes where? Cost of merchandise sold. A little bit odd. Cost of goods sold is an expense. Crediting an expense is rather unusual because it makes the expense go down. The reason we're crediting that expense is because when we sold those lightsabers, we put them into cost of goods sold at that time. Now we're canceling out the effect of that original sale. If the buyer has less inventory, the seller's got to have more inventory. 2 different amounts, but nonetheless. And if the buyer has more cash, the seller must have less cash.